Hello everyone, welcome back. Exactly what happened is this. One of the most battle-tested natural resource investors on the planet quietly trimmed about 80% of his physical silver position after silver exploded higher. And he didn't do it because he turned bearish. He did it because he thinks the next leg of the bull market won't be won by simply holding, but by rotating into the parts of the sector that can move even harder. And that single decision sparked a wave of confusion, rumors, and hot takes. Did he abandon silver? Does he know something you don't? Is this the top? The reality is more interesting, more strategic, and honestly, more useful for you, because it forces us to ask the uncomfortable question most people refuse to ask while prices are rising. When do you take profits? And how do you do it without blowing up the rest of your plan? Now, before we break this down, I need to say something quickly. My YouTube stats show a huge chunk of people watching these videos haven't subscribed yet. If you get value from my analysis, support the channel. Hit subscribe right now and drop OG John AG in the comments so I know you're really here. Also, if you want daily updates, extra posts, my personal takes, and the kind of instant voice notes I don't put on YouTube, I've created a WhatsApp channel. The link is in the description. Join it, because when markets move fast, waiting for the next upload is how people miss the real money. All right, let's talk about silver, gold, miners, and the psychology that separates people who keep their gains from people who watch them disappear. First, a quick market snapshot, because a lot of viewers ask where the action is right now. Physical demand has been loud. Premiums are still a topic, and for anyone shopping this week, there are fresh bullion specials floating around the market. Things like 1-ounce silver eagles priced under $9 over spot, and 1-ounce gold eagles with premiums sitting under $200 over spot, depending on inventory. Supplies come and go fast, and that's exactly the point. The physical market doesn't always move in sync with the paper narratives people obsess over. And that brings us to the first trap people fall into. Most people look at a chart, see the line going down, and they say, why would I buy something that's getting cheaper? Then they see the line going up, and they say, now it's safe, now I can buy. That is how the crowd gets engineered into buying high and selling low, without even realizing they're being guided by emotion. The investor I'm talking about has a phrase for the antidote. He calls it learning to love hate, meaning the easiest money is made when you buy what everyone hates and you sell when everyone finally loves it. Simple to say, brutal to execute. Because buying hate feels like you're stepping into a fight you didn't start. Everyone is louder than you. Headlines are negative. Friends laugh. Your own brain tells you to wait. But that's exactly why it works. When an asset is hated, the bar is low. Expectations are crushed. One small shift in reality can reprice it violently. Silver was that asset for years. Think back. For a long time, silver wasn't just ignored. It was mocked. It was dead money. It was too volatile. It was manipulated. It was the punchline of every mainstream portfolio. And that's why, when it finally snapped, it didn't politely climb. It exploded. But here's where it gets uncomfortable. When silver goes from around 20 to somewhere north of 70, it doesn't become more attractive. It becomes less attractive, arithmetically. If your thesis is the same and the price is triple, your margin of safety shrinks. That doesn't mean it can't go higher. It means the easy money has already been made. And that is the difference between a speculator and a believer. A believer holds because the story feels right. A speculator holds because the numbers still make sense. And when the numbers change, the speculator adapts, even if the story still sounds beautiful. So what did he actually do? He said, in plain terms, that his physical silver was bought as a hated, oversold speculation. His goal was to see silver recover and at least take out the old nominal highs. Instead, the market overshot his expectations dramatically. The target got hit, the objective was accomplished. So he sold the majority, again, not because he thinks silver is done, but because the role that physical silver played in his portfolio had been fulfilled. That's the part most people miss. Your portfolio isn't a religion, it's a system. Every asset should have a job. If an asset finishes its job, you either assign it a new job or you replace it with something that can do the next job better. So he sold roughly 80% of his physical silver. And then he did something that makes the internet melt down. He redeployed into areas with more torque, specifically silver equities and other resource plays, including oil and gas. Not because he stopped liking metals, but because he believes the stocks can deliver more upside from here than the metal itself, if you know what you're doing. Now, listen carefully, because this is where you need to personalize the lesson instead of copying a headline. He can do that because he has a competitive advantage in resource equities. He spent decades learning how to evaluate miners, royalties, streams, balance sheets, jurisdictional risk, management, financing terms, and the 1,000 tiny details that separate a real compounder from a promotional disaster. Most people don't. So for many of you, the correct move is not sell your silver because he sold his. The correct move is to understand the framework. Buy with a plan, write down the plan, and sell when the plan is complete. Then rotate based on your own skill set. And that brings us to the most important tool he teaches, the buy memo. Every time he buys something, he writes himself a one-page memo. Why he bought it, what could go right, what could go wrong, what price movement he thinks he can expect if things go right, what time frame it might take, and what would make him sell it. Then he reviews that template regularly, quarterly, and every time an individual investment has news to consider that news in the context of his reasons for buying. That sounds boring. It's not. It's survival. Because without that memo, the market will write the story for you. And the market story is always designed to push you toward maximum regret. When price rises, the market whispers, "You're a genius. Hold forever." When price falls, the market screams, "You're an idiot. Sell now." And if you obey that voice, you will do exactly what the crowd does. You'll buy late, sell late, and call it bad luck. The buy memo is how you block that voice. Now, he also said something that stings, especially in a bull market. Most people will miss this run. Not because the opportunity wasn't there, not because the facts were hidden, but because people needed price action to give them psychological permission. The reasons for higher precious metals prices have been sitting in plain sight for years. Debt, deficits, currency dilution, negative real rates, geopolitical tension, supply constraints. But the average investor doesn't act on facts. They act on feelings. And feelings are anchored to what just happened. So when metals were flat, people felt nothing. When metals exploded, people suddenly understood. That's why the crowd wants to buy silver at 80 when they refuse to buy it at 20. It's the same metal. The only thing that changed is their emotion. And that emotional pattern has consequences for the next phase. Because after the initial spring release move, the pace often slows. It doesn't mean the bull market ends. It means the market transitions from repricing to grinding. And grinding markets punish people who expect every month to look like the breakout month. So if you're measuring the future by the best month you just lived through, you're setting yourself up for disappointment. And disappointment is what causes bad selling decisions. Now let's talk about miners, because this is where the plot gets spicy. Typically the metals lead first. Then the highest quality, biggest producers move. Then later, the lower quality names and the speculative juniors get attention. It's a progression. Beta first, then alpha. But this cycle did something weird. In 2025, the smallest and most speculative mining names moved early, sometimes violently. That short-circuited the usual process. It dragged the penny dreadfuls upward faster than normal. And that created a distorted market where some of the best quality companies didn't move as far as you'd expect, while some of the riskier names moved much further than they deserved. So what did he do? He de-risked. He sold a chunk, about a quarter, of his junior mining exposure when he felt the sector had run ahead of itself. And he did it with a very specific goal. By giving up a portion of the upside, he could erase most of the downside. That's a trade disciplined investors make all the time, and undisciplined investors refuse to make because they're addicted to maximum upside. Then, with the proceeds, he didn't leave the sector. He rotated within it. He shifted some of that money into physical gold and into a basket of large, high-quality royalty/streaming and senior producer names. In other words, he didn't exit the resource theme. He moved toward quality and reduced fragility. And here's the line you need to tattoo into your brain if you want to keep what you make. You haven't made the money until you've taken the money. That's not a motivational quote. That's accounting. Unrealized gains are a story. Realized gains are cash. Now, a lot of people hearing this will instantly panic and say, so should I sell too? And that's exactly why this lesson matters. Because your decision cannot be based on a headline. It has to be based on your template. So here's what I want you to do mentally as we go through this. Ask yourself, what job does silver play in your life? Is it savings? Is it insurance? Is it a trade? Is it a speculation? Is it a hedge? Is it an emotional comfort blanket? Be honest. Because if you treat silver like savings, you'll behave differently than if you treat it like a trade. He treats gold like savings. He treats silver like speculation. That's why he kept the gold and trimmed the silver. Now, let's address the fear everyone has, but nobody wants to say out loud. If I sell and it keeps going up, I'll hate myself. That fear is the number one reason people ride a bull market up and then ride it back down. So he explains a concept I love, the difference between the sin of omission and the sin of commission. The sin of commission is losing money, buying something and watching it collapse. The sin of omission is money that theoretically you could have made that you didn't, selling too early and watching price continue. Let's make it concrete. If you bought silver at 20 and sold silver at 75, you made money. If silver goes to 90 after you sell, did you make less money? No. You already have the money. That's the difference between a missed extra and an actual loss. What happens to people is they feel good about being in the money, and the price momentum gives intellectual verification to the narrative, precisely as rising prices take away the attractiveness of the narrative. So it's very important that you establish a framework as to why you bought something and what might make you sell it, either as a successful speculation or an unsuccessful one. Now, he also describes something that should scare you in the best way possible. Selling a winning investment is psychologically harder than people think, because in a bull market you finally get what you've been craving: validation. If you held unpopular beliefs for years and got mocked for them, then suddenly price action proves you right. The psychological payment can feel as good as the money, sometimes better. That's dangerous, because markets punish addiction to validation. And here's the part that hit me. He said early in his career he rode a bull market up, felt invincible, and then held too long. He went from being a wealthy young guy in the middle of that bull market to having a net worth below zero after it ended. That's not drama. That's a scar. And scars create rules. Now, moving into the macro question that kept coming up. If official inflation doesn't look like hyperinflation, why does it look like the dollar is falling apart when measured against metals? His answer is simple. Inflation is the deterioration of purchasing power of your currency, and he believes the public numbers understate what people feel. He argues that official inflation measures are often constructed in ways that don't match real life, and he challenged people to do a simple thought experiment. Look at the basket of goods and services you bought in 2020 and price the same basket today. Gasoline, property taxes, health insurance, groceries, rent, mortgage payments, even the extra layers like insurance costs. Then ask yourself if your currency's purchasing power has only deteriorated by a couple percent per year. His broader point is that over long periods, the nominal price of gold often mirrors currency deterioration better than the official story does. Now, why does that matter for 2026 and beyond? Because if the next decade includes sustained currency weakness, then gold and silver can continue higher in nominal terms. But that doesn't guarantee a smooth straight line. It means you should expect volatility, pauses, and shakeouts. And that's exactly why discipline around buying and selling matters. Now, another question that came up was, when does the general public figure out they need gold and silver? He suggested the generalist investor is starting to participate, but we're not yet at the kind of broad mania that marks late stages. You can see early participation in flows into broad metals products, and historically, you often see silver begin to outpace gold when generalists start showing up. At the same time, he pointed out a funny contradiction. You'll hear loud, big targets thrown around for attention, while the conservative assumptions used behind the scenes remain far more cautious. That gap can create opportunity, because it suggests positioning may still lag the narrative. Now here's where the conversation took a turn that most people weren't expecting: the bank story. He explained that he and his partners tried to launch a new bank model, but the process dragged on for years. So they chose a different route. Buy an existing small community bank with a balance sheet simple enough to understand, then use that platform to expand services nationally. They started local, served the community, and then began building out features for broader customers. Things like multi-currency savings, interest-bearing accounts with checking, and for certain clients, the ability to hold gold and silver on deposit and lend against it. The key detail was this: they tested systems internally on their own money first, because you only get one chance to make a first impression. Now, I'm telling you this not as an ad, but as a signal. When experienced investors build infrastructure around hard assets and currency diversification, it tells you they believe the world is shifting. And that leads to the question you should be asking yourself. Are you preparing for a decade that looks like the last decade, or are you preparing for a decade that breaks the old rules? Because if the rules break, the winners will be the people who built their plan before the crowd arrived. Now, quick pause, because I promised you a creative mid-script intro. If you're the type of person who wants silver-related success stories, real examples of how people made smart moves and built real money, there's a separate channel linked in the description. Go subscribe over there too, because those stories can sharpen your mindset fast. All right, back to the main plot. The most viral part of the entire discussion wasn't the bank. It wasn't the inflation talk. It was the simple headline everyone wanted. He sold his physical silver. So let's make sure you understand what that means and what it does not mean. It does not mean silver is finished. It means his personal objective was hit, and he believes he can now get more upside by taking risk in a different vehicle. It's like someone cashing out of a winning bet and rolling the winnings into the next bet where they believe the odds are better. Now, here's the part most people forget. Doing that is psychologically harder than buying. Selling a winner is painful. It feels like you're walking away from a party too early. And in resource bull markets, the party gets loud. You finally get years of psychological validation. The crowd starts agreeing with you. The memes stop mocking you and start praising you. And that validation becomes addictive. So people hold, not because it's rational, but because it feels good. He said something that sounds almost crazy until you watch it play out. Investors complain more about foregone profits than they do about actual losses. People hate missing the last bit of upside more than they hate protecting what they already earned, until the cycle turns. So the discipline is to decide your exit strategy before the emotional intoxication arrives. That's why the buy memo matters. That's why the sell plan matters. That's why templates matter. Now, one viewer asked the classic question, what's hated right now? And the answer was fascinating. In a world of geopolitical tension and commodity headlines, very few resource sectors are truly hated. Even the pariah sectors start catching bids as soon as the narrative shifts. Energy can go from villain to hero in a week. Certain jurisdictions, though, remain hated. Places with perceived political risk and headline risk. Historically, that's where buy hate can pay, if you have access and if you can tolerate volatility. But he also admitted something important. It's hard to find a single stock that is universally hated and simultaneously mispriced in an obvious way. Those setups exist, but they require work and they require patience. Which brings us back to you. If you don't want to do that work, your edge has to come from simpler discipline, position sizing, diversification, time horizon, and not getting hypnotized by the last candle. Now I want to pull this into a real-world plan you can use this week. Step 1. Write your own buy memo for every major position you hold. If you own silver, write down why. Is it insurance? Is it a trade? Is it a hedge against currency decay? Is it a bet on industrial demand? Is it a long-term store of value? Don't write a novel, write a page. Make it clear. Step 2. Write down what would make you sell. Not price goes up. Be specific. Is it when silver hits a level that would let you pay off debt? Is it when your position becomes too large relative to your income? Is it when a macro condition changes? Is it when the narrative flips from hate to mania? Step 3. Review it quarterly and whenever big news hits. That's it. That's the whole edge. Because the people who get destroyed in bull markets are the ones who never decide what enough looks like. Now, I want to add one more important layer, your ability. If you are not an equity specialist, you do not have to chase maximum torque. You can hold physical. You can hold a basket. You can focus on risk control. He sold physical silver because he believes he can outperform by owning silver equities. That is not an instruction, it's a personal optimization. Your optimization might be different. Now, while we're here, I want you to know something. By the time you're watching this, a members-only video will already be live. It's a single, tight breakdown of the biggest updates so far, plus extra context I won't put in public videos. If you want the premium, in-depth analysis, and you want to show you're truly following the work, join the membership and watch that members-only upload. And while you're at it, if you're one of the people who's already doing well, maybe you caught a big move, built a business, landed a new job, paid off debt, drop your success story in the comments. Not as a flex, as fuel. Your win can push someone else to stay disciplined. Now, before we close, I want to turn this into a question for you, because this is where the comment section gets real. Do you personally treat silver as savings or as speculation? And second, if silver pushes even higher from here, what is your actual plan to take profits without panicking? Do you have one, or are you winging it? Answer those below. I read them, and your answers guide what I cover next. Now, let's tie the whole story together in the most practical way. A veteran investor bought silver when it was hated. He held through the disbelief. He watched the spring unwind. He hit his objective. Then he took money off the table and rotated into vehicles he believes can deliver more torque. Along the way, he reminded everyone of the core rules. Buy hate, sell favor, write your template, protect yourself from the sin of commission, and never let the crowd write your strategy. That is the real lesson. Not sell your silver. The lesson is stop outsourcing your decisions to headlines. Now, if you want me to keep breaking down metals, miners, and the psychological game of selling into strength, make sure you're subscribed. Keep the WhatsApp channel close for the daily updates. Check the members-only video for the condensed premium version. And if you support the mission to eliminate copycats and keep original analysis alive, you already know what to do. Comment OG John AG, share this with one serious friend, and I'll see you in the next one. Now, I want to slow down and unpack the part that most people rush past. The difference between selling because you're scared and selling because your plan says you should. Because there's a massive difference. Selling because you're scared usually happens after the market hurts you. It's reactive. It's emotional. It's the kind of selling that happens right after a scary red candle, right after a negative headline, right after your group chat starts panicking. That kind of selling almost always locks in regret. Selling because your plan says you should is proactive. It happens while you're still feeling confident. It happens when the comments are euphoric. It happens when your brain is whispering, "Don't ruin the fun." And that's exactly why it's so hard. So here's a practical way to do it that doesn't require you to predict tops. Pick 3 price zones ahead of time. Zone 1 is trim the froth. That's where you take a small slice off just to reduce position size and calm your emotions. It might be 5 or 10%. The goal is not to call the top. The goal is to regain control. Zone 2 is objective achieved. That's where the move you originally expected has happened. Your thesis played out. You're not guessing anymore. You're being paid. This is where you take more meaningful profits because you promised yourself you would. Zone 3 is mania. This is the part most people fantasize about, and it's the part most people fail to recognize until it's over. Mania is when everything becomes a certainty, when every influencer suddenly becomes a metals expert, when the dumbest questions start showing up, when leverage gets celebrated, and when your barber or your cousin starts asking how to buy. In mania, you don't need bravery to buy. You need courage to sell. If you use those 3 zones, you don't need a crystal ball. You only need honesty. Now, another thing he said is important for retention, so I'm going to repeat it in my own words. The chart is not your friend. The chart is your mirror. People look at price action and think it tells them what to do. In reality, price action exposes what they feel. When the chart is down, they feel risk, even if value is increasing. When the chart is up, they feel safety, even if risk is increasing. So if you want to become the kind of person who buys hate, you have to train your nervous system, not your opinions. Here's an exercise that sounds silly but works. When you see a hated asset dumping, ask, what would need to be true for this to be a gift? Not, what if it goes to 0? Not, what if I'm wrong? Those are normal thoughts, but they don't help. Ask what would have to be true for the market to be overreacting. Then check if those conditions exist. If they exist, you buy carefully. If they don't, you wait. That's the difference between disciplined contrarianism and reckless gambling. Now, let's circle back to miners because a lot of people misunderstand what torque actually means. Torque means a small move in the underlying metal can create a bigger move in the stock because the company's earnings are leveraged to the metal price. If a miner's costs are relatively stable and the metal price rises, margins expand faster than price. That's why miners can outpace metals during strong phases. But torque cuts both ways. If the metal drops, margins compress. If costs rise, margins compress. If management dilutes shareholders, your torque disappears. If the mine floods, your torque disappears. If a government changes rules, your torque can invert. So the way to use miners without getting destroyed is to treat them like a separate animal. You don't marry them. You date them with boundaries. And one boundary that matters a lot is liquidity. In bull markets, illiquid juniors can spike, and everyone feels like a genius. In corrections, those same names can gap down with no bids. The price you see is not always the price you can get. That's why, when he de-risked earlier, he didn't run away from the space. He moved up the quality curve. He reduced the chance that one ugly event wipes him out. That's a professional habit. Reduce tail risk while staying in the game. Now, the oil and gas rotation deserves a longer explanation because it ties into love-hate perfectly. Oil and gas is the sector that gets hated on a schedule. Sometimes it's hated because of politics. Sometimes it's hated because of ESG trends. Sometimes it's hated because of a recession narrative. Sometimes it's hated because supply appears too high. But the cycle doesn't care about feelings. The cycle cares about investment and depletion. Underinvestment today is supply stress tomorrow. And when the narrative flips, the bid shows up fast. So when he said he rotated part of his silver gains into energy exposure, the deeper point was not oil is guaranteed. The point was, I'm moving into areas where pessimism is still priced in, while optimism is starting to get priced into silver. That's rotation. That's how you stay ahead of narrative. And here's where I want to add a cliffhanger for you. If you're only holding one thing because you love the story, you're not investing. You're forming an identity. Identity investing is dangerous because identity hates being wrong. Identity refuses to sell. Identity doubles down when it shouldn't. Identity turns markets into ego. So be careful. You can love silver without being silver. Now, you might be thinking, okay, John, but how do I know whether I should rotate or just hold? Here's a fast filter. If you cannot explain in plain language why a specific stock should be worth more in 2 years, then you probably shouldn't rotate into that stock. If you cannot explain the biggest risk in one sentence, you probably shouldn't rotate into that stock. If you cannot explain what would make you sell, you definitely shouldn't rotate into that stock. Physical metals are forgiving. Bad stock picks are not. Now, let's talk about the part of the original discussion that almost everybody skipped: information overload. He basically said we're living under an AI fire hose. Clips, headlines, summaries, threads, and analysis come at you non-stop. A lot of it is recycled. A lot of it is amplified. And some of it is just people pretending to know. So your job is not to consume more information. Your job is to build a filter. Here's a simple filter you can use today. Does this information change my thesis? Does it change my time horizon? Does it change my position size? If the answer is no to all three, it's noise. If the answer is yes to one of them, you dig deeper. That's it. Now, I'm going to give you a microscript you can literally copy into a note on your phone, and you can use it for any position: silver, gold, miners, anything. Why I own it, my target, my time window, my biggest risk, what makes me sell. And if you want to level up, add one more line. What would make me add? Because there are times when the right move is to add, but only if your thesis is intact and the market is giving you hate pricing again. Now, I want to reinforce something I said earlier because people always twist this. Taking profits is not betrayal, it's risk management. You can be bullish and still sell. You can believe in silver and still trim. You can think prices go higher and still reduce exposure. The market doesn't pay you for loyalty. It pays you for timing, patience, and position sizing. But if you want results, you have to accept the tiring part. Now let me ask you one more engagement question that gets straight to the heart of it. When you look at your portfolio today, do you know what percentage of your net worth is in precious metals and miners? Yes or no? Because if you don't know that number, you don't have a portfolio. You have a pile. And piles get knocked over. Now, we're close to the finish line, but I want to connect the bank story back to your reality, because it's not just a fun trivia point. A lot of people buy metals because they want independence, but then they leave all their cash in a system that is moving in the opposite direction. More control, more surveillance, more friction, more debasement. So when experienced investors build financial plumbing that lets you save in multiple currencies, hold hard assets more cleanly, and potentially use those assets intelligently, it signals an attempt to re-engineer personal finance around stability instead of around constant dilution. You don't have to use that model, but you should understand why it's being built. It's being built because the world is changing. And if the world is changing, your strategy should not be a copy-paste of your past strategy. It should be a living system. So that's your homework. Write the memo. Decide the tranches. Know your percentages. And stop letting headlines bully you into emotional decisions. If you do those 4 things, you'll be ahead of 90% of the market participants. And that's how you stay in the game long enough to win.